Look, I've been doing this for over 50 years, and I can tell you right now, the housing market in 2026 is built on a foundation of pure delusion. Everybody wants to believe this time is different. Everybody wants to believe that somehow we've discovered some new economic law that repeals the basic rules of supply and demand. We haven't. We never do. And every single time someone tells me the old rules don't apply anymore, I know I'm looking at the early stages of a disaster. Let me be very clear about something. Housing is not special, it's not magical, it's not an asset class that defies gravity. It's a commodity with specific characteristics. And like every other commodity, it obeys the fundamental law of economics. When supply exceeds demand, prices fall. When demand exceeds supply, prices rise. Everything else is noise. Everything else is people trying to justify decisions they've already made emotionally, wrapping them in some kind of intellectual framework that makes them feel smart. I'm not interested in feeling smart. I'm interested in being right. Right now in 2026, we're sitting in the middle of one of the most distorted housing markets I've seen in my entire career. And I've seen a lot. I was there in the savings and loan crisis. I was there in 2008. I know what happens when capital gets too cheap, when underwriting standards disappear, when everyone from your dentist to your Uber driver thinks they're a real estate genius. What happens is always the same thing. The music stops, the liquidity dries up, and suddenly all these people who thought they were investors realized they were just speculators riding a wave of free money. The narrative right now is that we have a housing shortage. You hear it everywhere. Politicians talk about it, developers talk about it, the media repeats it like gospel, and there's some truth to it, but the truth is a lot more complicated and a lot uglier than anyone wants to admit. Yes, we underbuilt for about a decade after 2008. Yes, there are markets where we genuinely don't have enough supply, but the idea that this justifies current pricing across the board is insane, absolutely insane. Let me tell you what's really happening. We've had interest rates at historic lows for years, and that created an entire generation of buyers who got used to cheap money. When rates were at 3%, people could afford a lot more house than they can now. So what happened? Prices got bid up to levels that only made sense in a 3% world. Then the Fed started raising rates because inflation got out of control, which anyone with half a brain could have predicted. And suddenly we're in a completely different environment. Now you've got mortgage rates that are double what they were, and you know what that does? It destroys affordability, completely destroys it. But here's the thing, nobody wants to talk about prices haven't adjusted to reflect this new reality. Not really. You've got sellers who are anchored to the peak prices they saw in 2021 and 2022. They refuse to accept that their house isn't worth what it was when money was free. They sit on the market for months, making tiny little price cuts, hoping some sucker will come along and pay yesterday's price in tomorrow's market. It doesn't work that way. It never works that way. Eventually, reality asserts itself. Eventually, sellers capitulate, but we're not there yet, and that's why the market is frozen. Transaction volumes are down massively. People aren't buying because they can't afford to buy at current prices with current rates. People aren't selling because they're locked into mortgages at 3%, and they don't want to give that up to go buy another house at 7%. So you've got this standoff, this weird stasis where everyone's waiting for someone else to blink. And in the meantime, the market is barely functioning. Low transaction volume is not a sign of health. It's a sign of denial. Now, let me talk about the supply side, because this is where it gets really interesting. Everyone says we need more supply. Fine. Let's build more. But here's the problem. Construction costs are through the roof. Labor is expensive. Materials are expensive. Land is expensive. Permitting takes forever. Regulations make it nearly impossible to build anything at a reasonable cost in most of the places where people actually want to live. So what's the replacement cost for new housing in desirable markets? It's astronomical. And that creates a floor under prices, right? If it costs $500,000 to build a house, you're not going to sell it for $400,000. But here's what people miss. Just because there's a floor doesn't mean there's demand at that level. You can have a situation where the replacement cost is high and the market clearing price is lower, and you know what that means? It means nothing gets built. It means the market stays stuck. Developers can't make money building at replacement cost if buyers can't afford replacement cost. So they stop building, or they only build luxury product for the narrow segment of the market that can still afford it. Meanwhile, the broad middle of the market gets squeezed. And this is where demographics come in, like who's buying houses right now. Like you've got millennials who are finally hitting their peak earning years, trying to buy their first homes. They've been told their whole lives that they need to own real estate, that renting is throwing money away, all the conventional wisdom. So there's demand from that cohort, but they're also saddled with student debt. They're dealing with high rents that make it hard to save for a down payment. They're competing in a market where prices are still inflated from the cheap money era. It's brutal for them. At the same time, you've got baby boomers who own most of the housing stock in this country. They bought their houses decades ago, their mortgages are paid off, or they're paying nothing in interest. They're sitting on massive equity gains, but they're also aging. Eventually, they're going to downsize or move to retirement communities or pass away. And when that happens, you're going to see a wave of supply hit the market. It's coming. It's demographic destiny. But nobody knows exactly when, and nobody knows how quickly it'll happen. That uncertainty is hanging over the market like a sword. Here's another thing. The quality of underwriting has deteriorated again. I know, everyone says we learned our lessons from 2008. We have all these regulations now. We have stress tests. We have qualified mortgage rules. Yeah, it's better than it was in 2007. But it's not good. You've got people stretching to buy houses they can't really afford. You've got lenders who are loosening standards at the margins because they need to make loans to justify their existence. You've got these new non-bank lenders who aren't subject to the same regulations as traditional banks, and they're making questionable loans. It's not as bad as last time yet, but the seeds are there. And let's talk about investors. Institutional investors piled into single-family homes after 2008 because they could buy at massive discounts and rent them out for positive cash flow. That was smart. That made sense. Buy below replacement cost, generate income, wait for the market to recover. But then everyone and their brother wanted to copy that playbook. You had investors buying houses at peak prices with the assumption that rents would keep rising forever. You had people buying houses they've never even seen sight unseen just to get in the market. That's not investing, that's speculation. And speculation always ends badly. Now, some of these investors are underwater on a cash flow basis. They're making negative returns. They thought they could flip, or they thought rents would cover everything, and reality didn't cooperate. So what do? Some of them are stuck. Some of them are going to have to sell at a loss. And when they start selling, that's going to put more pressure on prices. This is how corrections happen, slowly, then all at once. I want to talk about geography because this market is not monolithic. There are markets that are genuinely constrained by supply. San Francisco, New York, places where you literally cannot build because there's no land, or the regulations won't allow it. In those markets, prices might stay elevated because the supply constraint is real and structural. But there are also markets that went absolutely crazy during the pandemic, places like Phoenix, Austin, Boise, Nashville. Everyone wanted to move there because they could work remotely and the cost of living was lower. So prices doubled in 2 years, doubled. You think that's sustainable? You think that's based on fundamentals? It's not. It's based on a temporary shift in behavior driven by a once-in-a-century pandemic. And now that people are going back to the office, now that the work-from-home revolution isn't quite what everyone thought it would be. you're seeing those markets cool off fast. The problem is a lot of people bought at the peak in those markets. They thought they were getting in early on the next big thing. They thought they were smart, and now they're sitting on houses that are worth less than they paid, or they're barely breaking even, and they're realizing that they bought into a narrative instead of buying into fundamentals. I've seen this movie before. I've seen it 100 times. The details change, the location changes, but the story is always the same. People confuse a temporary dislocation for a permanent trend, and they get killed. Let's talk about policy, because government always makes things worse. Always. You've got politicians talking about affordable housing, which is code for subsidies and regulations that distort the market even further. You've got zoning laws that prevent density. You've got building codes that add cost without adding value. You've got rent control in some cities, which is the single dumbest policy you can implement. If you actually want more housing, rent control reduces supply. It always has, it always will, but politicians love it because it sounds good and it buys votes, even though it makes the problem worse in the long run. And then you've got the Fed, which is stuck between a rock and a hard place. They raised rates to fight inflation, which was the right thing to do, but now they're dealing with a sluggish economy, and they're getting political pressure to cut rates. If they cut too soon, inflation comes roaring back. If they keep rates high, the housing market stays frozen and the economy slows down even more. There's no good answer. They created this mess with a decade of zero interest rate policy, and now they're trying to clean it up without breaking everything. Good luck with that. Here's what I think happens. I think we're in for a prolonged period of price stagnation in most markets, with pockets of real decline in the markets that got the most overheated. I think transaction volumes stay low until either prices come down enough to make sense at current rates, or rates come down enough to make current prices affordable. One of those two things has to give. The market can't stay frozen forever, but it can stay frozen a lot longer than people think. I also think we're going to see more distress. Not 2008 level distress, but distress nonetheless. You're going to see developers who took on too much debt and can't service it. You're going to see investors who can't carry negative cash flow properties and have to sell. You're going to see homeowners who stretch too far and can't make their payments when they lose their job or have some other financial shock. And that distress is going to create opportunity for people who have liquidity and patience. Because here's the thing, this is when you make money, not when everyone's bullish and prices are rising and you're fighting over deals. You make money when everyone else is scared. You make money when there's blood in the streets. You make money when you can buy assets below replacement cost from motivated sellers who have no choice but to sell. That's the game. That's always been the game. But most people don't have the stomach for it. Most people want to buy when it feels safe, when everyone else is buying, when prices are going up, and that's exactly when you should be selling. I've built my entire career on being a contrarian, on zigging when everyone else zags, on buying when everyone else is selling and selling when everyone else is buying. It's not complicated. It's not some secret formula. It's just discipline and patience and a willingness to be uncomfortable. Most investors don't have that. They want to be part of the crowd. They want to feel validated. They want to be able to go to a cocktail party and talk about their smart investments. I don't care about any of that. I care about returns. I care about buying right, and you don't buy right when the market is hot. Now, I promised you I'd tell you where I see the next major distortion forming, and I'm going to deliver on that. But first, let me say this. The distortion is already here. It's been here. It's just that most people are looking in the wrong direction. Everyone's focused on residential. Everyone's talking about single-family homes and affordability and first-time buyers. And yeah, that's a mess. But the real distortion, the one that almost nobody is paying attention to, is in commercial real estate tied to demographic shifts and remote work. You've got office buildings in major cities that are half empty and will never fill up again. You've got retail that's been gutted by e-commerce. You've got these enormous mortgages coming due on properties that are worth a fraction of what they were when the loans were originated, and the lenders are pretending everything's fine because they don't want to mark these loans to market and realize the losses. It's extend and pretend all over again, but you can't pretend forever. Eventually, these buildings are going to have to be repriced or repurposed or demolished, and when that happens, you're going to see massive dislocation in commercial real estate that will make the residential market look tame by comparison. And here's where it connects to housing. A lot of these office buildings are in downtown cores of major cities, cities that are also dealing with housing shortages. You know what the smart play is? Convert these empty office buildings into residential, but it's not that simple. The buildings weren't designed for residential. The economics are tough. The permitting is a nightmare, but someone's going to figure it out. Someone's going to buy these distressed office assets for pennies on the dollar and convert them into housing. And that person is going to make a fortune. That's the opportunity. That's where I'm looking. But back to residential. The ugly truth is that the housing market in 2026 is broken. It's not functioning properly. Prices are too high relative to incomes. Rates are too high relative to prices. Supply is constrained, but not as constrained as people think. Demand is there, but it's not effective demand because people can't afford to transact. You've got sellers who won't sell and buyers who can't buy, and a market that's just sitting there treading water, waiting for something to break. And something will break. It always does. Markets don't stay in disequilibrium forever. Either prices come down or incomes go up or rates come down or some combination of those things happens. But the adjustment is coming. And when it comes, there's going to be opportunity for people who are prepared. So what do? If you're thinking about buying a house to live in and you can afford it and you're planning to stay there for a long time, then buy it. Don't try to time the market. Don't wait for the perfect moment. Just make sure you're not overpaying egregiously, and make sure you can handle the payment even if your income drops or rates go up. If you're thinking about buying as an investment, be very, very careful. Understand the replacement cost. Understand the cash flow. Don't assume appreciation. Don't assume rents will rise. Underwrite conservatively and demand a margin of safety. And if you can't find deals that meet your criteria, then don't do deals. Patience is a position. If you're selling, be realistic. Understand that the market has changed. Understand that buyers have options and they're scared and they're not going to overpay. If you need to sell, price it right and get it done. If you don't need to sell, maybe wait. But don't sit there with some fantasy price that has no connection to reality and wonder why you're not getting offers. And if you're just watching from the sidelines, waiting for the right moment, keep your powder dry. Keep your liquidity. Stay patient. The opportunities are coming. They always come. And when they do, you want to be ready to act. The ugly truth is that most people are going to lose money in this market. They're going to buy too high or sell too low or hold too long or panic at the wrong time. That's what happens in every cycle. The winners are the people who understand the fundamentals, who don't get caught up in the hype, who can see through the narratives to the underlying reality. Be one of those people. Now, if you want to think like an owner instead of a speculator, if you want to understand markets instead of just reacting to headlines, hit subscribe, hit like, because I'm going to keep telling you the truth even when it's uncomfortable, especially when it's uncomfortable. And leave your thoughts in the comments. Tell me what you're seeing in your market. Tell me where you think I'm wrong. I'll try to respond honestly, even if the answer isn't what you want to hear, because that's the only way any of us get better at this game. Stop chasing trends, understand the numbers, demand free cash flow, look for value where everyone else sees trash. That's how you win. Lou.